Hello, and welcome back to Trust Talk, the podcast from Truss Financial Group, where we break down mortgage options for borrowers whose finances do not always fit neatly inside the traditional lending box. I'm Jason Nichols, your host and CMO at Truss Financial Group.
And I'm Jeff Miller, CEO of Truss Financial Group. It is good to be back. At Truss, we specialize in non-QM mortgage solutions designed for self-employed borrowers, real estate investors, and homeowners looking for more flexible ways to qualify or access their home equity.
Let's begin. So, Jeff, we get this question constantly from homeowners. They have equity sitting in their home and they want to access it. And the two options they keep hearing about are a HELOC and a cash-out refinance. And most of them have no idea which one actually makes sense for their situation.
Right? And the problem is most people just Google it and get a generic answer that doesn't account for their specific rate, their timeline, or what they are actually trying to do with the money.
Which is exactly why we are breaking it down today. Real scenarios, real numbers, no fluff. Let's get into it. Jeff, let's start simple. For someone who has never done either of these, what is the actual difference between a HELOC and a cash-out refinance?
Okay, so think of it this way. Your home has a value. You subtract what you owe on your mortgage. What is left is your equity. Both of these products let you access that equity, but they do it in completely different ways.
Can you please walk us through each one?
A cash-out refinance replaces your existing mortgage entirely. You get a brand new loan, usually at a higher balance, and the difference comes to you as cash. So if your home is worth $600,000 and you owe $300,000, you might refinance into a $400,000 loan and walk away with $100,000 in your pocket. But now you have a whole new mortgage. New rate, new term, new payment.
And a HELOC is different?
Oh yes, completely. A HELOC sits on top of your existing mortgage. It does not touch it at all. You open a line of credit against your equity, and you pull from it only when you need it. Your original mortgage stays exactly as it is.
So essentially, your first mortgage is untouched.
Yep, untouched. And that is actually the most important thing people miss when they are comparing these two options.
Jeff, why does that matter so much?
Because of where rates are right now. A lot of homeowners locked in a rate of 3% or 3.5% 2 or 3 years ago. If they do a cash-out refinance today, they lose that rate forever. They are now refinancing at today's rates, which are significantly higher. So yes, they get the cash, but their monthly payment goes up considerably, and they are paying more interest over the life of the loan.
So they are essentially trading a cheap mortgage for an expensive one just to access their own equity.
Yes, when you put it that way, it sounds even worse. But yes, that is exactly what is happening. And in most cases, that is not a smart trade.
Jeff, so when does a cash-out refinance actually make sense then?
It makes sense when your current rate is already high. If you bought in 2023 at 7.5% and rates have dropped since then, a cash-out refinance can lower your rate and pull cash out at the same time. You win twice. But if you are sitting on a 3% rate from 2021, you should never touch that mortgage. Never.
And that is where the HELOC becomes the smarter move.
By a mile. You protect that low rate on your first mortgage, and you open a HELOC to access the equity you need. You only pay interest on what you actually pull out. And at Truss, our no-appraisal HELOC can fund in as little as 5 days. No appraiser walking through your home, no 60-day wait, just fast access to your equity.
5 days is a game changer, especially for investors or business owners who need to move fast.
Right, and that brings up another key difference. A HELOC is a line of credit. It is revolving. You pull what you need, you pay it back, you pull again. A cash-out refinance is a lump sum. You get it all at once, and you start paying interest on all of it immediately, whether you use it or not.
So if someone needs $80,000 for a renovation that is going to happen in phases over 6 months, a HELOC is far more efficient.
Because they are only paying interest on what they have drawn, not on the full $80,000 sitting in their account waiting to be used.
Jeff, I want to touch on something because a lot of our listeners are self-employed or real estate investors. Does the qualification process look different for these two products?
It can, and this is where a lot of people run into friction with traditional lenders. For a cash-out refinance, most conventional lenders are going to want full income documentation, W-2s, 2 years of tax returns, the whole package.
Which is a problem if your tax returns show low income after write-offs.
Oh, absolutely. Try walking into a big bank as a self-employed borrower making $20,000 a month, but your tax return shows $40,000 for the year because of deductions. They look at that number and the conversation is over before it started.
And that is exactly the borrower we built our products for.
Right? At Truss, we offer no tax return HELOCs. We look at your bank statements or the cash flow from your rental property instead. So that self-employed borrower who is actually earning strong income every month can still qualify based on what is actually hitting their account, not what the tax return says after all the write-offs.
So the product is built for how real people actually earn.
That is exactly the point. The modern homeowner is not a W-2 employee with a perfectly clean tax return. They are entrepreneurs, investors, consultants, and they deserve access to their own equity just as much as anyone else.
All right, let's bring this home. If someone is sitting there right now with equity in their home and trying to decide between these two options, what is the one question they should ask themselves first?
Simple. What is my current mortgage rate? If it is under 5%, do not touch your first mortgage. Open a HELOC and keep that rate protected. If your rate is already high, a cash-out refinance might give you a better rate in cash at the same time. Run the numbers both ways before you do anything.
And if they want to run those numbers with someone who actually knows what they are doing,
TrussFinancialGroup.com. The quote engine is right there. You can see what you qualify for in minutes without any impact to your credit score.
perfect. Thanks for tuning in to the Truss Financial Podcast. If this helped you think more clearly about your equity, subscribe so you never miss an episode. We will see you on the next one.